Good morning, everyone, and welcome to the Cirrus Report. My name is Ken Shorgen, and I'm here with the great and illustrious London Paul. And Paul, there was an interesting analysis that came out from the Nomura Group in regards to what may be taking place with the economy, and more importantly, what it looks like some of the monetary policies by the Fed, perhaps fiscal policies by whoever is running the government, that could create what is considered to be a feedback loop. And that feedback loop appears to be where the Fed has to continuously monetize and provide liquidity to the financialization of the markets, at the meantime trying to deal with the propaganda or perception of the general economy, while both of them are starting to collapse. Anyway, I want to thank you as always for being a part of this discussion, and welcome, Paul.
Yes, and likewise, Ken. Obviously, very pleased you're here too. Yeah, it was just something that I observed and I thought, is potentially is an interesting discussion point. So yeah, it talks about what it terms it could trigger because there's Friday jobs data, which is out tomorrow. Now, obviously, we know historically we've seen these huge revisions to job data to the tune of 818,000 jobs over a 12-month period. So don't want to get too much speculating into is this jobs data even accurate, because that's a statement of the obvious, but it talks about what it says a vicious feedback loop between the markets and the economy. And that's a situation where obviously any negative news can drag markets lower, which then creates even more negative news. And, it's like a snowballing effect in reverse. Now, the question is, and we've seen data over the years where it happens, why the perception that this could be the start of this vicious feedback loop? I mean, and obviously the statement is, well, the Friday jobs report could surprise more by being weaker than expected, and then the equity market starts selling off. Now, really, would that you then consider it to be indicative of broader problems? I don't necessarily think so. But they're basing this on the assessment or on a comparison with what was the dot-com crash. It came before the recession in April 2001. I remember that very well at the time. Now, why are they even saying this? And this stacks up against all this other broader metrics of concerns about the financial system, concerns about the broader economy, concerns about the fact the Fed we're in the month of September, is going to have to lower interest rates. But they make the point, if you go back to just prior to that point in 2001, that the S&P 500 and the NASDAQ indexes fell by 24 and 56% respectively. That was from peaks in August 2000 to when they fell in March 2001. And then they talked about how the ISM manufacturing index fell, stay below 50 was what's important about 50. 50 is regarded as being in contraction. There's no growth. And that happened from August 2000 until February 2002. Therefore saying, look, factory manufacturing business, and okay, bear in mind as well, this was 2000 to 2002 when the world was very different in the United States in terms of its manufacturing, but the argument is that it was in contraction mode. And obviously unemployment rose to 4.2% in January 2001. And of course, they're making comparisons because the Fed actually cut interest rate in January 2001 when the stock market started to correct. So they're trying to say, could we see a comparison? I mean, the world's very different in 2024 than it was in 2001. I mean, we didn't have all this debt. We didn't have anywhere near the severity of the problems. But if you go back to 2001, the Fed slashed the Fed funds rate by 4.75%. So they're trying to say, well, can history repeat itself? Well, yes, potentially. I mean, and although I think obviously the situation's far worse now, But they've said if you look like before the dot-com crash, household net worth as a percentage of disposable income has risen substantially, and the IMS manufacturing index is in contraction as well. And obviously, yes, investors have, but you have to put this in context. The markets have been a bit jittery, but of course, the stock market saw its worst sell-offs. Remember, there was that huge sell-off early August because of this whole fear about the yen carry trade, etc., etc. Well, there's no doubt if you look in 2024, US unemployment, these official data, remember that unofficially it's way higher. US unemployment's probably 18%, something like that, because of course they rig all the data, but officially, if you go back to January of this year, it was 3.7%. In July, it was 4.3%. I mean, already people are going, well, I think there's a logical argument that says, well, the Fed should have cut interest rates, but we're back to this point, as we have to keep reiterating, the Fed has no choice in some ways but to keep interest rates high, because slashing interest rates is admitting they can't defend the dollar anymore. It's got nothing to do with inflation. And we've said all this before, so let's not repeat ourselves. But what they say is, as a closing point, and this is very telling for me, is they say when a vicious feedback loop forms between falling asset prices, now falling asset prices in 2024 is infinitely bigger problem than even it was back in 2001, 2002, because everything's been predicated on endless asset bubbles, principally, obviously, since 2008. But it said when you have it between those and a weakening economy via what it says, negative wealth, confidence, and loan collateral effects, the Fed responds more rapidly and forcefully. So is this a situation where they're basically saying, look, and I would be in agreement that you've got to slash interest rate, because what's more important ultimately is the US economy. Now, I know historically that's not the case for them, because the argument's always been, well, the US economy can blow up. Yeah, we may have a year of problems, unemployment might rise a bit more. Yeah, some businesses will go to the wall, but this time it's very different because everything is at risk, and not just the economy itself and people's jobs and businesses, etc., but also there's the risk of what it does to the broader financial system. The risk is, of course, because they've got a budget deficit that's just ridiculously high. I mean, yes, traditionally for decades the US has ran budget deficits, but not like we're seeing now. That then we're back to that, getting sucked into having to go to endless QE and all the problems that causes in the process. So in a way, they're trying to telegraph why the Fed should react the way they do. I'm trying to make some comparisons, which to some extent I think is fair. I mean, okay, for me, things are infinitely worse than they were in 2001. So the argument is, if the Fed then slashed interest rates 4.75% in reaction to this, well, the argument is they have to slash it to minus 4.75% now. Okay, I'm being ridiculous, but I'm trying to emphasize a point that things are far more severe now than they were then. So that's the kind of background to this, Ken. There's what they've said in this article, and I think we'll get your feelings on what they've said in that.
Yeah, and interestingly enough, you take a look and you go back. I want to go back really to Burns, and I'll just touch on this real quick. Burns has always held, the former Fed chairman, he's always held as a point of doing stimulus and lowering rates too quickly into a recession of the late 1960s. But the problem is that the Fed was more interested in the dollar, in bond yields, and in the general economy. They really didn't have any say or into the stock markets. That really changed in 1987. When the 1987 crash, Greenspan was shook, and he made it his mission that the Fed now would try to do everything in its power to avoid stock market crashes. So now all of a sudden they took upon a mandate that they shouldn't have, and we're now experiencing the legacy of that 40 plus years into the future. 2001 was as I think even Greenspan said, too much exuberance. What did we see in the 90s that we really didn't see for the rest of the time? We saw the rise of the IPOs. People were going public with things, from dog catching equipment to, who knows? It just anybody could borrow money at the lower interest rates, start a business. It couldn't, you didn't have to sell anything. You just had to have the perception you were a company. People would invest in it. The stock price would go to the moon, and et cetera. And that all crashed, obviously, the dot-com bubble. Then in 2001, really, we were in a recession, but we were also into a war cycle. And we've been in that war cycle ever since 2001 with Afghanistan, Iraq. And then when Afghanistan ended, we very quickly went into the proxy war of Ukraine. The U.S. has been trying to create and foment conflict as much as possible, whether it's the South China Sea, whether it's the Middle East, Ukraine, et cetera. They're trying to keep that war cycle going because really since 2001, that's been the main catalyst that has sustained. Things changed when the Soviet Union fell and the end of the Cold War. It led to companies, lobbying Congress to get rid of Glass-Steagall, to bring in NAFTA so that they could go offshore. They had to find something to keep the gravy train going. Well, 2008, of course, after you have this housing bubble, this domestic housing bubble, which was the big thing of the early 2000s, now all of a sudden the Fed intervenes, and the Fed intervenes on everything. And if there's any feedback loop, the feedback loop really, in my opinion, is that follow the Fed. The financialization system that was created out of that era and the general economy that has been completely separated and segregated from what the Fed is supposed to focus on. It's no longer on bonds and the general economy and jobs. It's on keeping financialization going. We see this by the repo market, reverse repo market, protecting the banks, bailing out the corporations, allowing for all of this financialization to take place. And as we get to a real recession that neither the Fed nor the fiscal policies of Congress can deal with, really the central bank has no idea how to deal with the general economy anymore. When you mentioned jobs, that's coming out on Friday, there's 4 different real jobs reports. There's the ADP report, which is more of a private sector BLS of the farms report. There's the BLS unemployment jobs report. There's the continuing unemployment claims report. And then there is what's the other one that, there's another one that also comes through. So you've got 4 of them, but jobs are always lagging indicators. They're good 6 to 9 months, an indication of what the real economy is. And anybody with 2 brain cells knows, you take a look at manufacturing, you take a look at PMI, take a look at CPI, we are in a recession. It's just been masked because the financialization of Wall Street and the banks and that they don't even pay attention to the general economy anymore. So with that being said, what's going to happen if the Fed, which says it's likely to lower rates in September, how is that going to affect the general economy? In my opinion, it's not. It's really, since the Fed now is focused on Wall Street and having to deal with de-dollarization, the general economy is probably going to get either stagnant or worse. And if they lower rates, inflation is going to roar right back. as de-dollarization continues, they have to monetize everything. And to me, that's the real feedback loop. The more that they have to monetize, the more inflation goes, the worse recession goes, and the worse the overall general economy goes.
Yeah. And then what, of course, affects the real economy is when asset prices start falling sharply. So this is why they can't have housing markets cratering. I mean, and this is why they think in China, just a small aside, but an important aside, is they think China can't afford to have this, commercial real estate and just retail real estate corrections there because it'll blow their economy up. It won't blow their economy up because their economy doesn't suffer from financialization. The housing market threatened to cause a component of it, and this is why Xi a few years ago went, "This can't happen." But coming back to the US, it is why you have to have always have asset prices rising. It's the only way to sustain financialization. But the problem is, and this is why they can't afford to allow equity markets to crater and crater and crater. And the longer they don't lower interest rates, the risk of that happening. It's not that in reality, the Dow falling to 30,000 should actually have that bigger impact on the real world, but it does. Because it creates, as they say, all this lack of confidence. Then all of a sudden, no one wants to loan to businesses, and the whole basis of financialization is endless credit. Well, no one's going to provide that. So businesses will start to collapse. So then it starts to really impact the real economy, which is already seriously impacted. But the problem is if they start slashing interest rates, and they really should have long since done it, then the question is what happens to the dollar? And then that starts to have a serious impact on the broader economy as well. So they're stuck between a rock and a hard place. There's nothing they can do anymore. Whether they, and I've always said this, you can't slash interest rates or raise interest rates or do anything because the economy is not overheating. They raised interest rates to protect the dollar and it's failed. So now they have to hold their hands up and go, we can't protect the dollar anymore. So that therefore, then what starts to happen if you slash interest rates? Well, gold and silver still will arguably keep rising. But then, and this is the other thing, because the argument would then be, and really in reality, this shows how dumb the system is, because when you raised interest rates to over 5%, equities should have got smashed. That's normal. But in the world of financialization on steroids, equities just kept rising, and which is a complete contradiction. So that's why we had record highs in like the Dow and record highs in the DAX, etc., because that's what financialization does. And it's really the only answer, because apparently if you have all these bubbles, it creates confidence in the broader economy and everyone thinks the economy is great, even though Joe next door lost his job and Jim down the road lost his job. That doesn't matter. It's perception. It's all perception management. Well, perception management's going out the window, and the real economy is already suffering irrespective of financialization, because you cannot have QE zero interest rate policy for as long as they did, and then you can't stop raising interest rate. You can't have a situation where you don't have a real economy anyway because you exported the real economy abroad and everything depends on endless consumption, which is just impossible, because how much consumption can any person have? What are you going to do? Buy a new fridge freezer every 6 months, new sofa every year? I mean, it's just ridiculous. But that's what the economy depends on. So I think it's just they're at that point of no return. So I think the article makes a number of valid points. It's comparing data and saying, well, the same things apply. But, the policy decisions made in 2001, 2 were very different to now, because we didn't have financialization the way we do now. Not everything didn't depend on bloated asset prices. And a small other point I want to make is, what have you noticed again, that every time equities get hit, what also gets hit? Bitcoin. because there's a direct correlation between the two. And never lose sight of that statement of fact. I'm not going to get into the rest of Bitcoin, but there's an interesting observation. So what's also, I think, very interesting, because normally when equities get smashed, you'd expect to see gold and silver fall. In fact, the reverse has happened. And therefore, the question is, what's really going on? So I think in a broader sense, you can arguably say that the Fed's at a point of no return, that US economic reality is, and the proverbial's about to hit the fan, where, you can't hide economic reality anymore. And the consequence is that when does economic reality actually start to seriously impact the financialization, not the other way around? And I think that's also an observation that seems impossible in some ways to believe, but I think we could be at that point, and then financialization impacts the real economy. So it's like that. You could be arguably could be a vicious feedback loop as well, where one component feeds off the other. And I think, for me anyway, at least, that's an interesting observation. I'm not sure what you think, Ken.
No, I very much agree, and I really don't have too much to add. I guess the only thing I will add or put in this aspect is everything now to keep the system going has had to be on perception management. Reuters on August 30th came out with a headline: OPEC Plus likely to proceed with planned output hike from October, sources say. Just 5 days later, they contradicted themselves with a headline that was the exact opposite: OPEC Plus discussing delay to planned oil output. Now, did OPEC really do that? Well, one, they don't name the actual sources, it's the anonymous sources. But what did it do? It saw that oil prices were going up, and so they slammed it. In just those few days, we see oil go down $3 to $4. It's all about perception management. Goldman Sachs came out with a note saying that the economy does better under President Harris, which obviously we know that under Biden-Harris, it has been extraordinarily atrocious. And that tells you everything you need to know about Wall Street. Wall Street only cares about financialization. The banks, the central bank, and even now the politicians who are bought and paid for do not care at all about the economy, fixing the economy, or dealing with the economy. The jobs numbers have been manipulated for a good 18 months, and they get revised down every single month. So the fact of the matter is everything has to be perception managed for the public to keep them in the dark. In the meantime, they have to keep the status quo, or the system of financialization completely collapses. So that's another feedback loop unto itself. When the propaganda no longer is believed, things are really going to accelerate and get worse overnight.
Yeah, absolutely. And just one final point worth making, Cam, with regards to Reuters. Reuters will just be given something, and Reuters' perspective on this is, well, this is factually correct, because why would somebody give us something that wasn't factually correct? The observation there is, and we don't know who this is, but who feeds Reuters this information and says, put this out? That's the more interesting question. And, but you're absolutely right. It is all about perception management. So you do indeed see these contradictions happening. And how often do we see something, or the algos react to something? But sometimes the algos themselves have a completely dysfunctional response and do exactly the opposite to what they're supposed to do. And then suddenly, I guess something has to intervene and correct that problem. But that's the basis of the financial system. So eventually, one day, and it could happen a lot sooner than we think, it's a final point to ponder over, is when all this algos, when all this high frequency trading, when everything stops working, reality kicks in, something happens, and there's no liquidity in these markets either. You're going to see market movements I think when 50 years time, when this happens, people will be talking about this going, do you remember that time when that happened? I mean, and some people will be asking, how did it happen? What caused this? And then there'll be a reflection upon the fact that financialization of economies and of markets was the biggest, most idiotic policy decision the West ever made. And they made it for one reason. They actually thought this was a way of stimulating economic growth because all this huge wealth that would be created by doing this would trickle down so the likes of Ken and I and you listening would benefit from this. How anyone ever imagined for 1 minute that was reality seriously just beggars belief. And I'll just leave that point for everyone to ponder on.
Absolutely. Anyway, Paul, thank you very much for being a part of this great discussion.
And likewise,
And to everybody here, thank you for being a part of the Cirrus Report community. Don't forget to subscribe, like, make a comment, share with anybody you think this would be important to. And until the next time we get together, have a great day.